Hi everyone. We will begin with Chapter 1, Audit Framework and Regulations. And first of all, at 1.1, we will talk about the concept of accountability, stewardship, and agency. What is the meaning of accountability? Who is accountable to who? Now, in the corporate world, the directors are accountable to the shareholders because shareholders owns the company and directors are running the operations of the companies for the shareholders. The roles of the directors are actually managing the business. They govern the entire business. So definitely they are accountable to the shareholders who are the actual owners of the company. So here comes to the needs that the financial report prepared by the directors are required to be audited so that the financial statements of the companies are more credible. And that's where the concept of stewardship will comes in, where one person manage another person's property. Agents are people employed or used to provide a particular service. So we are referring to directors. Directors are agents of the companies. Companies are managed by directors for shareholders' wealth. So in short, we are talking about directors are accountable to shareholders. Just for your informations, the exam papers will not focus too much on this area. So there is just a concept why the financial statements has to be audited. And that's where we make the investors, who are the shareholders, will be having more confidence over the truthfulness of the financial statements. Now we move into 1.2, the meaning of true and fair view. We always know that auditors will express an opinion on the financial statements after the accounts has been audited. Auditors will say whether the financial statements are actually giving a true and fair view or not. Now, what is the meaning of true and fair view? First of all, there is no legal definitions for the terms true and fair view. So that's the first point that you are going to know. Well, let me show you the annotated version. No legal definition of the terms true and fair view. It is because this true and fair view is just a dynamic concept as the expectation of the public is constantly changing. As you know, accounting standards are changing. So what does it mean by true and fair view? The accounts is correct. It simply means the accounts is correct. But what is the meaning for accounts is correct? How do I define whether the accounts is correct or not? So the simplest way to define it is that the preparation of the financial statements, the preparation of the accounts is following exactly the accounting standards. And where accounting standards is changing, that is why we couldn't say something is true and fair forever. The expectation of the public is constantly changing, as if the true and fair view is constantly changing as well. So we can't give a legal definition for it. Like, for example, as I say, beautiful. So, what exactly is beautiful? Isn't that the concept of whether someone is beautiful or not is depending on the expectation of the public, like following the recent fashion trend and so on and so forth. In certain period, something might be beautiful. In different generations, something may not be beautiful. So it's depending on what are the expectation of the public at that moment of time. So that's why true and fair view has no legal definitions. This is the first point that you need to know. Second point, we have to try to define what is the meaning of true. True means information is factual. We report whatever transactions in the financial statements truthfully. We report it correctly. So these are another 2 points to explain the meaning of the word true. Information was correctly taken up based on the source documents. Like this is a sales invoice. The amount is 1,000. So you have to record 1,000. What does it mean by fair? Fair means the information is free from bias. We do not prepare the financial statements with the intention to overstate the assets value or understate the liabilities and so on and so forth. We don't do that. That is the meaning of fair. We try to be objective. We try to be free from bias. And fair also means that we are reporting the substance, not the legal form. So what does it mean by substance over form reporting? For example, the company just bought a car using a bank loan. The company will record the motor vehicle as an asset. It is a non-current asset to be used by the company. But if you are looking into it from the legal form perspective, the car is actually belonging to the bank. The true owner of the car is actually the bank because the loan is still not finished repaid yet. So in terms of the legal form, the motor vehicle, the car, supposed to be capitalized by the bank. But we don't do that. In accounting, we will report the substance. So who actually owned the car? It is the owner, it is the company who owns the car. So the company is the one to capitalize this car in the non-current assets. While the bank, who is the true owner under legal form, they don't capitalize the car, but instead the bank will record a receivable from their customers because the bank will collect the money from the company. So this is the meaning of substance over form. As a summary, true and fair view means you report the actual figures based on the transactions, and the accounts are actually prepared free from bias and using substance over form reporting. In case the exam questions ask you about the meaning of true and fair view, the questions will be coming with 3 to 4 marks requirements. So I am giving you 5 points for you to remember so that you can answer the exam questions accordingly. Let's move forward to 1.3. We talk about assurance engagement. Now, what is assurance? First of all, we have to know the meaning of assurance. Like people used to say, I assure you this product is good quality. You won't be having any problem for the coming 1 year or 2 years with this product. I will be giving you guarantee that this product will not be defective. Otherwise, you can exchange one to one. Have you experienced something like this when you buy something? This is called the assurance. Yeah, people give you the assurance that this product is of good quality, so you will feel more comfortable to buy it. Now, in financial reporting, when you wanted to invest in a company, you will definitely look at the financial reports. You want to see whether this company is profit making or not. You want to see this company has potential or not. But who will tell you this financial reporting, these accounts are actually reliable, are actually something that you can trust? So you will need an assurance. You need someone to assure to you whether you can invest in this company or not. And auditors will be the one to audit the financial statements, collect the evidence to prove that these financial statements are correct. Then they will issue the auditor's report. And the function of this auditor's report is to provide an assurance to the investors. Of course, besides investors, there are also customers, other stakeholders for more assurance so that they know the financial statements are reliable. Of course, we also have non-assurance engagement. Like auditors can do accounting work or taxation work. In those kind of engagement, auditors will not provide any assurance. Auditors do not write a report to tell people that this account is definitely correct. There's no such thing for that. So that's called non-assurance engagement. However, this is not our focus in the syllabus. Our focus will be the assurance engagement because the entire topics about audit is whether auditors can provide an assurance to the users of the financial statements or not. So let's look into the 5 elements of an assurance engagement. This area is a popular area that will be tested in the exams, especially in section A. So you please take note on the 5 elements of assurance engagement, which usually I will call it CERT, CERTS. Whenever you talk about assurance engagement, like auditors performing an audit engagement or review engagement, these are all the assurance engagement. And definitely they will have these 5 elements. First, we talk about criteria. Criteria is like the standards, the accounting standards. You need to evaluate the accounts against something to know that whether the accounts is prepared correctly or not. It's like a benchmark. The accounting standards is like something that you will use the financial statements to compare with to it. So this is called the criteria. Like for example, the accounting standards. So you will know whether the financial statements are prepared correctly or not because you got something to compare with, something to be evaluated. So next is about evidence. You wanted to provide assurance engagement, auditors must have to get evidence. If you don't have the evidence, how can you confirm the financial statements are actually correct? So you need to keep evidence. And also, auditors will issue an assurance report. So R stands for report. Every assurance engagement, definitely there will be a report. For example, the auditor's report, the review report. Without a report, people don't usually find the assurance. Yeah. So definitely a report will be issued by the practitioner, which is the auditors. T stands for three-party relationships. It is always having 3 parties, which include the practitioners. In here, I will give you an example, which is the auditors. The intended users are referring to whoever used the financial statements. For example, like shareholders, also include other stakeholders such as creditors, bank, customers, employees, and so on and so forth. Whoever used the financial statements, they can see the auditors issued the report to say that the financial statements is giving a true and fair view, so they will have better assurance. Of course, there will be a responsible party who are the one who responsible to prepare the financial statements. So this financial statements is prepared by who? So for example, it is the management who prepare the financial statements. And lastly, we have S. S stands for the subject matter, which is the financial statements prepared by the management. So you can see that subject matter means the subject matter prepared by the responsible party will be evaluated against the criteria. Criteria is referring to the accounting standards. So remember, these 5 elements of assurance engagement will be helping you to score some marks in section A. Well, we look into more details about the different types of assurance. We are generally having 2 types of assurance. Now, to make things simpler, can I tell you in such a way? Like, I am a salesman and I assure you this product is of good quality. So I will be giving you 3 years product warranty. And any problem with this product within 3 years, I will give you one-to-one exchange. You can exchange a new one without questions. And the second product, you can buy it with a lower price, but I can only give you a guarantee of 1 month. After 1 month, if anything gone wrong, I won't be responsible. So which product you would think that I am giving you more assurance? Of course, the 3 years one. So why? Because I am there enough to give you 3 years products warranty with one-to-one exchange. Then you can see I am so confident with the products, it won't become defective. Now comes to financial reporting. Can auditors give users of the financial statements, whoever read the financial statements, such a high assurance or not. Now, if can, we will call this as reasonable assurance. If not, then we call this as limited assurance, which is a lower level of assurance. It's not that there is no assurance. If no assurance, I don't even give you the 1 month guarantee. But at least I gave you some 1 month or 6 months or whatever. You don't feel like you get nothing, but it's a lower level of assurance. So let us talk about one by one. About the first part, reasonable assurance are referring to high levels of assurance. So I will need you to remember the points that I have marked it down. High level of assurance that the user of the financial statements will feel very confident about the financial reporting is actually reporting the correct figures. The reporting is correct. And it gives you a positive reporting. Positive reporting means the auditors will tell exactly their opinion. Like for example, auditor says the financial statements are giving a true and fair view. So that's a form of positive reporting. He tells you directly, is it true and fair view or not? However, reasonable assurance is not an absolute level of assurance. That means auditors cannot 100% guarantee that the financial statements are actually correct. Reasonable assurance, in another way, I would say that auditors can tell 95% of the chances that the financial statements are going to be true and fair, are going to be correct, are going to be free from material misstatements. So auditors cannot give 100% guarantee. Never auditors can give absolute assurance level. Why? Then we have to look into inherent limitations. These are the few reasons why auditor cannot 100% guarantee the financial statements are correct. First of all, auditors will select samples to test. Auditors do not test every transactions. So that is a possibility that some of the transactions are not selected as a sample, but they are misstated, and therefore the misstatement would not be detected. As auditor doesn't check 100%, they don't test 100% of the transactions, then we know that auditors cannot give 100% guarantee that all the transactions are correctly taken up. Number two, financial statements will include judgmental areas, subjective areas, where auditors are difficult to know whether they are actually correct or not. For example, the management charges depreciation for the non-current assets at 20%. How do I know 20% is correct? Probably it could be 25%, it could be 30%, who knows? There is no such thing we can confirm it is correct or not. So certain areas are very subjective in nature, so no one can guarantee they are actually correct 100%. Number three, inherent limitations of systems of internal control. By the way, let me just briefly run through with you what is the systems of internal control. Management will have to implement systems of internal control so that they can make sure the financial statements are taken up correctly. Like for example, they have a computer system rather than a manual systems to record the sales transactions. Of course, the computerized system will be more accurate in terms of taking up the sales transactions. We'll be having less chances for the sales will be omitted because we are using computerized system. So computerized system is actually one of the systems of internal control. It's better than operated manually. And management will make sure their internal controls are actually good enough to record the accounting transactions. Can I say management cannot guarantee their systems of internal control will 100% effective, 100% functional? Management dare not to confirm such a thing because there could be inherent limitations of systems of internal control. Even management make sure their systems of internal controls are good, but management, they can't be say for sure that their internal controls have no problem at all. So since management cannot guarantee their systems of internal control has no problem, how could auditors ensure their financial statements are 100% correct? So this is one of the reasons, and auditors cannot give absolute assurance. Next, we are looking into evidence is persuasive but not conclusive. Whatever evidence the auditors get is more likely to show that the transaction is going to be that way, but no one can say for sure. Whatever evidence you get, it might be wrong as well. Example, someone is suing your audit client and you are the auditors. You know the company will have to make a provision because most likely they will lose the case. If they lose the case, they have to compensate their customers. So they have to make a provision for this amount based on the accounting standards. So you go and get the confirmation from the lawyer. And you are the auditors. You manage to get the confirmation from the lawyer says that this court case, they are about to lose it. So you are now feeling quite sure that they will need to make a provision. Who knows? At the end of the day, surprisingly, they won the court case and they don't even need to pay a single cent of the compensation. It is possible, but whatever evidence that auditors get it makes things looks like that way, but eventually it is not. This is possible. So even though you can get such audit evidence, things might go the other way around. Yeah. That is why auditors cannot give absolute assurance. Now, the other two reasons are less important. Audit report format. Non-accountants may not understand what the auditor's reports are actually saying, and they might misunderstood about the meaning. And lastly, historic information. Some information published might have been sometime after the year end. That's why the information published may not be updated anymore. Generally, I would need to remember around 4 reasons for inherent limitations in case the examiner asks in section A or section B, you can answer accordingly. Let us look into the next part, the limited assurance engagement. Limited assurance engagement is a lower level of assurance. Like the examples I given earlier, the seller give you 6 months warranty, not 3 years, but 6 months. So this is what we so call the moderate levels of assurance. There are some assurance. You can't say totally there is no assurance, but not as high as reasonable assurance. It is a lower level of assurance compared to a reasonable assurance engagement. It gives a negative reporting. Now, why is that a negative reporting? I am having one example for you over here. So this is a review engagement. Review engagement means the auditors perform a review rather than audit. Auditors doesn't do audit. Auditors just doing a review. And then you can see that in the review engagement, the conclusion mentioned here, based on our review, nothing has come to our attention that causes us to believe that these financial statements do not present fairly. So auditors would not say the financial statements are giving a true and fair view. They don't say that because that is only for reasonable assurance, which is a high level of assurance. That's why auditors give positive reporting. This is a negative reporting. It sounds something like this. Based on our review, nothing comes to our attention why I think these financial statements are not correct. So another way to say is like this. Yeah. I don't see why you are not nice. But I never say you are nice. So which one is better? You are excellent. And I don't see why you are not excellent. Which one will make you feel better? Definitely the earlier one, you will feel better. Oh, you are excellent. So how about the other way around? When I say negative reporting, I don't see why you are not excellent. I never say that you are excellent. So this is a moderate level of assurance. There are some assurance, but not as high as the reasonable assurance. So this is an example of a review reporting where practitioner give a conclusion which is a negative reporting. They say, I don't see why your accounts are not true and fair. But I never say that it is true and fair. All right. So here are the comparisons between reasonable assurance and limited assurance. Please jot down the summary of the notes over here for some comparisons over here. So let's look into first difference. Level of assurance. For reasonable assurance, auditors are giving higher level of assurance, but it is not an absolute level of assurance. Compared to limited assurance, it is just a moderate level of assurance. In other words, it is a lower level of assurance compared to a reasonable assurance. In terms of the amount of work, of course, auditors wanted to give higher level of assurance. They will have to test more. They have to select more samples. Just like when you ask your doctor to give you a medical report, you just want a medical report for your own review. Do you think the doctor would test a lot? Probably he would just randomly do some tests, send your blood to the lab, then they come up with the result. But when you tell your doctors you want the report for insurance claim, then the assurance level is greater. Your doctor will afraid mistake. So then doctor will test more. It's very logical. You wanted to give more assurance to the financial statements users, you have to do more work. That is why under reasonable assurance, which is audit engagement, auditors will do more work, like test of controls and a lot more substantive procedures. We don't go into the technical meaning of these words for now, just letting you know the concept that audit will need more work. On the other hand, when auditors only give limited assurance, because the assurance level is not as high as the audit engagement, so we don't actually need to do so many things. So there are less work compared to reasonable assurance. Probably auditors will perform inquiry and substantive analytical procedures only. We will look into the meaning of these technical words in the later chapter. So for now, the concept is that limited assurance, auditors will do less work. Now, what kind of report that auditors will issue? For reasonable assurance, auditors will give positive opinion, whereas limited assurance will be giving a negative conclusion. How about the cost to the client? There will be higher cost to the client for reasonable assurance. Of course, higher cost because auditors will have to do more work. For limited assurance, it will be lower cost to both clients and auditors. So here are the examples. When you audit the financial statements, auditors are going to provide a reasonable assurance. When we do a review of cash flow forecast, so you can't be telling that the forecast is actually correct, right? Because no one will know what will happen in the future. Forecast is like we predict what will happen in the future. So management predicted they will have this amount of cash in the next 12 months, but who knows? So they ask you for a review. You are the auditors, you can review their trend and then you can tell some negative conclusion about their cash flow forecast. But you can't say that the cash flow forecast is true and fair because no way you can do that because the forecast is actually future predictions. How can a future prediction be true? We don't know what will happen in the future. But if it is more likely to be that way, you can actually give a negative conclusion, such as you don't see why the forecast is wrong, something like that. So here are some of the differences for you to know about the comparison between reasonable assurance and limited assurance. So let's have some time to jot down these notes for your own revisions. I do have some questions for you to go through that you may just treat it as a small exercise to test your understanding about chapter 1. So let's get some time to complete these questions. Then we will come to a discussion in a short while. Let's begin with our discussion. For question number 1, not an element of assurance engagement, we are looking into the 5 elements, CERTS. And from what I see over here, it looks like the regulatory body is not one of the elements. Question number 2 is about limited assurance engagement. Definitely, a negative assurance will be associated with limited assurance engagement. Number 3, auditor's report does not provide absolute assurance. Why? Because management may override systems of internal control. Management themselves implemented the internal controls, but they cannot make sure it is 100% functional. Or they are the one who override the systems of internal control. They don't follow the systems of internal control. That is why management cannot make sure their accounts are correct 100%. And also, there is no way for auditors to do the same. Number 4, which of the following statements referring to review engagements are correct? So based on what I see over here, definitely they can't be giving high level of assurance. They can't be positive assurance. So the answers left with 1 and 2 only. Bank will be using for review engagement. Like for example, the forecast for the cash flow, or a bank might want to see a review report for that for lending purposes. And review engagement is not so detailed like the statutory audit. These two are actually correct. Number 5, in the auditor's report, the auditors give their opinion on which of the followings. Of course, giving opinion on whether the financial statements are prepared following the accounting standards or not, and the financial statements are true and fair or not. So we are not looking into internal controls, and we don't give opinion on internal controls as well. So answer is 1 and 4. All right, for that, we comes to an end for chapter 1. Chapter 1 will most likely be tested in section A, less likely to be tested in section B, just for your information.